Hello everyone, here is Ali Talabi. Welcome back. This is our fourth lesson from module 7. We started our conversation regarding the stock and we introduced the stock and the concept and I show you a listing and explain how the stock market jargon actually they make sense and what they mean. And then we start our conversation regarding the stock valuation. This is our third lesson, which is specifically we're talking about the stock valuation, and it is the last one. So we talk about the DDM, dividend discount model, and I mentioned that's one of the major common ways to find the value of the stock. However, the major issue with DDM is we assume there are some dividend payments, and either they're growing or they're fixed. But the major assumption here is there are some dividend payments. But the question here is, what if the company is not paying dividend? Either, for example, they have the negative EPS, so they are not making any money yet, or they might make some money, but for some reasons, for example, they're reinvesting all this money to their operation, they are not paying any dividend. So we talk about comparables. That's one of the appropriate ways just to measure the value of the stock for these companies. But there are two other major common ways we can use to find the stock value. The first one is called REIM or residual income model, and the second one is called free cash flow. So I'm going to talk about these two approaches specifically today. So let's start with the residual income model. So I mentioned this model is one of those models which we can use for the companies which are not paying any dividend, but still they are making some money. So their EPS is positive. They have some earnings for shareholders. So we can use this approach. But how this approach works? In this approach, instead of using dividend, we are using EPS or earnings per share. And there is one major assumption behind our logic. Now, what is that assumption? The major assumption here is called clean surplus relationship. In a nutshell, it means that the book value of the shares are changing over time. And the major reason that they are changing is the additional earnings which are left at the company. And what is that additional earning? That's EPS minus DPS. Because we learned in previous lesson, that the company can keep and hold some of the earnings and reinvest in the operation, or they can pay part of the earnings to shareholders. The part which is paid is called dividends. So the EPS minus DPS is showing how much of their earnings is left or remained at the company. So based on this assumption or relationship, the argument here is the difference is actually determines the book value changes. So the book value of the share is changing over time, and the major driver of this change is actually the changes, the difference between the EPS and DPS. So if the company is keeping more money in the company, they can reinvest in the operation, go with new projects, so the book value of the company will go up. So if we accept this assumption relationship, and we can replace and go back to actually the Gordon formula, and we can replace the DPS with EPS minus B1 plus B no. So this formula P no equals dividend divided by R minus G. That's the Gordon formula. We call that DDM, dividend discount model. And if we replace the dividend with the argument we just had, a clean surplus relationship, the result will be a new formula which is based on EPS. You see, there is no dividend here. We're just using EPS. So EPS 1, again, the earnings for the future period, minus the current book value per share times the growth rate divided by R minus G. So you can use this formula as well to find the stock price. However, remember, when you are talking about this formula, we are assuming the company is still making some earnings, the profit, there are some profits there, so you can use that. But maybe say, Ali, what if the company is not paying dividend and the earnings is also negative? So it's very common that for many companies, even those companies which are listed in NYSE or NASDAQ, many of those companies, maybe they don't make any profit. Their EPS is negative. So for sure, we cannot use a research income model in this case, but sorry, residual income model for this case, but we can use something which is called free cash flow. So let's talk about the free cash flow. So, I mentioned there are some companies who are not maybe making any earnings, so their earnings is negative. However, the cash flow is positive. Maybe you say, Ali, is it possible to have the negative earnings or net loss, and on the other hand, to have the free cash flow? And the answer here is yes, you can have free cash flow, which is positive. So the reason is behind the free cash flow calculation. So we can use the free cash flow calculation. Now, look at this formula here. You see, the free cash flow is mainly showing how much money is left at the company after paying out all the interest, all the taxes, and whatever is left at the company, it's called free cash flow. And we call that free cash flow not because it's free, because this is available to the company. So we can use this formula. So EBIT is earnings before interest and taxes, which is net operating profit actually for the company. And we are deducting the tax. We are adding back depreciation. Why? Because depreciation is non-cash expense. It's not actual cash outflow. Now, the company might spend some money on CapEx, capital expenditure. So they might buy some equipment, so you're paying out for that. And also for current operation, the company is paying for the working capital. As a reminder, net working capital, that's the difference between current assets and current liabilities. When it comes to cash flow estimation, I will talk in more details regarding the net working capital. But for now, remember, net working capital, that's the difference between current asset and current liabilities. So we are taking out the investment of the company on net working capital. So whatever is left, as I mentioned, it's called free cash flows. Now, that's available money the company can pay interest or can pay dividend to shareholders. So you will see that this free cash flow might be positive because you are not taking out all the expenses. You are just starting with operating income. So we can use this to find the value of the company. And now I'm going to explain how you can find the free cash flow how you can use the free cash flow to find the value of the company, and based on that you can find the stock price. So we can use free cash flow to find value of the firm, and based on value of the firm, we can find the value of the stock. But how does it work? So let's look at the example to explain the situation. Let's assume the current free cash flow of the firm is $1,000. The growth rate of the free cash flow is 5%, and the discount rate, or WACC, weighted average cost of capital, is 10%. What is WACC? WACC is the weighted average cost of capital. So that's the average cost of financing for the firm, expressed in percentage. So including both debt holders and shareholders. If you remember, for shares, we use cost of equity, or the discount rate for equity, we use R. But we cannot use the same rate here. Why? Because when it comes to the value of the firm, you're talking about the total cash flow, which is available for all investors. So in this case, if you are going to discount all these future cash flows, you have to use the appropriate discount rate. And the appropriate discount rate here is the average cost of financing, which we call that WACC. When it comes to capital budgeting, I will talk more about WACC, how we can drive back. But for now, let's assume your cost of financing on average is 10%. We can use this formula to find the value of the firm, which is free cash flow 1 year from now divided by WACC minus G. You see, this formula is different than the stock price in which we calculated based on dividend. So the formula, which we called Gordon formula, was based on dividend and the cost of equity. But here we are using the free cash flow. Again, this is value of the firm. The total cash flow for the whole investors are more kind of relevant than just the dividend, which is for shareholders. And also we are using the cost of capital, the average cost of capital, which is for the whole firm as well. So if I just plug in the numbers here, I can find the value of the firm. Be careful, here is free cash flow 1 year from now. So you have to grow your free cash flow by G%, which is 5%. So it's $1,000 times 1.05. This is the whole thing. Here is the free cash flow 1 year from now. The WACC is 10% minus G, which is 5%. So if you use this formula, if you plug the numbers, you can find the value of the firm. So let me just calculate that. So 1,000 times 1.05, which is 1050, divided by 5%. So this gives you $21,000. So that $21,000, that's the value of the firm. So it's $21,000. That's the whole value of the firm. However, we are not looking for the value of the firm. Our goal here is to find the stock price. But we know the value of the firm is based on two major accounts. And remember this from our balance sheet argument. We know from accounting that the total value of the firm is based on the value of the liabilities and value of the shareholders' equity. So from that argument, you can say that the value of the shareholders' equity is value of the firm, or the total value of the assets minus value of the liabilities. Now let's assume for this specific firm, the value of the liabilities is $10,000. So if that's the case, you can find the value of the shareholders' equity by deducting actually $10,000 from $21,000. So this gives you $11,000. So this is the value of the shares, the value of the shareholders' equity. If you divide this number, $11,000, by the number of outstanding shares, you can find the stock price. So let's assume this specific company has 1,000 shares available. So if you divide $11,000 by 1,000 shares, you can find the stock price, which in this case is 11. So we can say that the stock price based on this argument is $11. So free cash flow, again, that's an appropriate approach when the company doesn't pay any dividend and it doesn't generate a positive income. In other words, you don't have net income, you have net loss. In this case, you can use the free cash flow approach to find the stock price, but you have to make some adjustment and for sure some assumptions. Thank you very much. Here is Ali Talabi. This is the end of our lesson. Next lesson will actually finish our lectures and we'll talk about technical fundamental analysis, and also we'll talk about efficient market hypothesis, or EMH. Have a wonderful day. Talk to you soon. Take care.